This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to another episode of Value Investing. Before I start today's show, I just wanted to let you know that I created a website called shareinvestmentideas.com. So this is the website where you can share your investment ideas with other people for free. The membership is free, and I created this platform to post my investment ideas and to meet with my listeners and meet with other fellow investors. And I'm planning to post my investment ideas there, so please check it out and see if it's going to be worth for you to join the membership as well. The only thing you need to join the membership is your email and name. That's all. And let's just discuss various investment topics there. I look forward to doing that. Another announcement that I want to make here is that instead of creating this podcast episode once a week, I decided to go with once in 2 weeks model. The reason why I want to reduce the frequency of this podcast is that I have been quite busy and has been a little bit challenging for me to work on multiple projects, and I decided to ramp down the podcast production. But that doesn't mean that I'm not going to add value to you guys listening to my podcast. I'm trying to do my research and it will add a lot of value. And as I mentioned, I created a website. So there I'm going to write various articles with respect to investing and especially related to value investing. And I hope that you guys can learn something from there as well. So let's come back to the show, and in today's episode, I want to talk about risk arbitrage. And this is probably the field that a lot of you guys are not familiar with. So let's just go over what it is about and what kind of strategies you can use to implement this type of investment technique. So before we do that, I just want to give you a quick disclaimer that this podcast is for entertainment purposes only. And it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? So as I mentioned in the intro, today's show is about risk arbitrage. What is risk arbitrage? So let's just talk about the definition of risk arbitrage and move on to pros and cons of these strategies and how you can implement this strategy. So risk arbitrage arises when company A announces that it plans to buy company B for a certain price. So let's just assume that the company B is selling before the announcement $30. And company A announces that it plans to buy the company B for $50. Then what happens is the stock price goes up from $30 original level to not all the way to $50, but it goes up to, let's say, $48. So there's $2 spread between the current price after the announcement, $48, to final announced price, which is $50. So the reason why we have this $2 spread is because there is a risk of the deal falling through. And there's always probability associated with the deal going all the way to the final close date. So in order to compensate for the risks that investors have to bear when they go into this investment situation at the price of $48, there's a spread like $2 spread and $3 spread depending on the deal. So you have to calculate annualized rate of return for that kind of situation and see if the risk is small relative to return that you are getting from this spread. So that's the typical risk arbitrage situation. And let's talk about first pros and cons of this strategy and why you may want to implement this strategy or you may not. So let's just get into the details. First, what are the benefits for investors? So the clear benefit that you are getting from risk arbitrage situation is the fact that there's very little correlation with the overall market. Because when risk arbitrage situation arises, what happens is there's a timetable attached to the deal, which means company A announces that it's going to buy company B within certain time period at certain price. So even if the market goes down, there's going to be little correlation with the market, unless the company A announces that it's going to provide its own stocks to buy company B. And this is alternative to cash investments. So if you're not sure about the market condition and if you want to set aside some cash is not going to earn a lot of interest, as you know, given the low interest environment. But if you invest your money here in this kind of situations, then you're going to have low market correlation with the overall market, and you can make decent amount of money and decent rate of return. So that's why a lot of people get into this kind of situation. Then what is risk associated with this type of investment strategy? There's a big downside risk. So if the deal doesn't go through for whatever reason all the way to the end, then the stock price is going to go back to the original level or even further down. And that's going to give you a huge investment loss, at least paper loss at that point in time. So let's say in this situation, company A decided not to pursue the deal with company B, then stock price is going to go down from $40 to $30. So it's about 38% down. And the return that you're getting, the annualized rate of return that you're getting from this hypothetical deal is going to be 20% if it closes within 2 months, 12% within 4 months, and 4% within 1 year. So it depends on the timetable associated with the deal. And in order to get this kind of return, you have to think about a chance of deal falling through, which will translate into 38% down from your original investment. So those are the pros and cons and upside and downside of this kind of strategy. So let's go over some of the important things that you have to keep in mind when it comes to risk arbitrage. The first thing you definitely need to calculate is probability of the deal going through all the way to the end. So let's just talk about in detail a little bit later. But two other things you have to keep in mind, which I already mentioned, is the first, you have to think about spread. So you have to calculate annualized rate of return in terms of the current price and final target price. And you also have to calculate annualized rate of return based on the timetable associated with the deal. If the timetable expands far in the future, your annualized rate of return is going to go down further and further, as we discussed in this hypothetical example. So 20% within 2 months, 12% within 4 months, and 4% within 1 year. And if you look at legendary investors like Warren Buffett and Joel Greenblatt, they have implemented this strategy before. So while Warren Buffett recognized the benefits of a diversified approach, he tended to concentrate in a smaller number of attractive deals in this space. So when he managed his investment partnership, he didn't just implement this strategy for 50 securities a year. He only implemented this strategy for only 1 or 2 securities in a given year. So he was very careful because, as I mentioned, there is a huge downside risk. And Joel Greenblatt also mentioned the risk associated with this strategy. So if you don't know what you're doing, then you probably want to stay away from this area. But if you know what you're doing, this is a great way to gain some high annualized rate of return for your cash. Because the reason why you put your cash in your savings account and some portion of your cash in your stock portfolio is because you want to be protected from downside of stock market, right? So since there's little correlation with overall stock market, this is a good way to implement your investment strategy. the timetable is important. Spread is very important. You have to calculate annualized rate of return, and probability of the deal going through all the way to the end is very important. So those are the three key things you have to keep in mind when it comes to risk arbitrage situation. Why don't we go into the details with respect to probability of the deal going through all the way to the end? So it's better to have your own checklist to understand this kind of probability. And the best strategy is what Warren Buffett implemented a long time ago, which is you look at various risk arbitrage situation in a given year and only pick a few securities that have minimal probability of deal falling through at some point. So how do we check that? And my recommendation is to create a checklist and go over them and only invest your money when the deal satisfies all of these points on your checklist. Why don't we just go through the checklist and see if it makes sense to you? The first one on the checklist is you have to ask questions like, was the deal announced official or rumored? And if you're just buying a security based on rumor, right? So let's say the company A is rumored to buy company B at some point in the future, then your probability of the deal falling through is going to be very high because it's just rumor, it's not confirmed, and that's just common sense. So it's better to buy and get into this situation when the deal is officially announced by acquiring company. The second question that you have to ask is, what is the rationale behind the acquisition decision? So is it driven by financial gain or is it driven by strategic decision? So if it's a strategic deal, then it's better than financial deal. Because strategic buyers tend to pay a lot more and they have more desire to have the deal going through all the way to the end. But it's purely driven by financial gain. Depending on the stock market and depending on how a deal is structured, they can always back out in the middle of the negotiation. So it's way better to just get into this kind of situation when the acquiring company is trying to buy the other company for strategic reasons. The third one on the checklist is, has the acquirer built up a stake in the target already prior to the announcement? So this one also makes sense because if acquirer had, let's say, 30% already stake in the past for the target company, then it's way easier for acquirer to accumulate the other 70% of stake. And acquirer already has known this target company for a long time because the acquirer had 30% stake. It's way more familiar for acquirer shareholders and it's way easier for the deal going through all the way to the end. So this is a really good sign that you can see if acquiring company already has big stake in the target company in the past. The fourth one that you want to check is the acquired company smaller in size relative to the acquiring company? So you want this one to happen because in some cases, acquired company is larger in size or relatively the same in size compared to the acquiring company. If the acquired company is smaller in size, then there are various things that are good for investors because acquiring company does not have a lot of financial burden to acquire smaller company. And also there's going to be less regulatory scrutiny from regulators. And it's going to be way easier. In many cases, you don't even need a shareholder approval if acquired company is smaller in size. So because of those reasons, you want the acquired company smaller in size relative to the acquiring company. The fifth question that you want to ask is Is it likely for the acquiring company and acquired company's shareholders to approve the deal? So you want to check if this is friendly or hostile takeover. And you also want to understand who is the largest shareholder, if there's any controlling shareholders, and whether or not they agreed on the deal. Because if one shareholder has large stake in acquired company and he or she already agreed to the deal, then there's a high probability that the deal is going to go through all the way to the end. So you want to do the analysis in terms of shareholders in both sides of spectrum. On one side, you have to understand shareholders of acquiring company, and on the other side, you want to understand the shareholders of acquired company. The sixth question that you may want to ask to yourself is the deal expected to be done via cash or stock? Because in some cases, acquiring company just provide its own stocks to acquired company shareholders. And in other cases, they just buy the company via cash. The better option for investors is cash, because if there's stock exchange between an acquiring company and an acquired company, then you have to do the calculation in terms of how many shares you have to short for acquiring company and how many shares you need to buy for acquired company in order to have the spread. And if the deal doesn't go through, in some cases, you may suffer from both sides of the deal structure. So acquiring company's stock price can go up when you short that stock, and acquired company stock can go down if deal doesn't go through. So you can definitely lose a lot of money if the deal is structured via stock exchange. But if it's cash, then it's relatively simple and you don't have to calculate all this exchange, and it's probably better. The next one you want to check is whether the funding is already secured. Does the buyer have a sound balance sheet with low debt level? And you want to check how the funding is going to be secured. And if you check the balance sheet of acquiring company and if it has a lot of debt, then definitely that's a red flag. And also, as I mentioned, if the acquired company is smaller in size, it's relatively simple and easier for acquiring company to secure the funding. And that's probably not a big problem for acquiring company. But if acquiring company is similar in size, then it's going to have some hard time, or smaller in size is going to have a hard time to secure the funding, and this is area that you have to pay a lot of attention to. Eighth question that you may want to ask is, what is the regulatory risk? So in many cases, if the deal brings a lot of concerns to regulators, then they're going to try to block the deal, and you'll see some of the deals blocked by U.S. government or other countries' governments. So there's antitrust issues, and there are various reasons why the government is trying to block the deal. In some cases, national security reasons, in some cases, antitrust issues. So those are the things you want to check before jumping to the bandwagon. Okay, so the last thing you want to check is if there's any unusual clauses in the contract. This probably is going to be a hard thing for you to check because you're not a lawyer. But if there's anything unusual, then you probably want to check it out before you're making any investments. So those are the things that I have on my checklist when it comes to risk arbitrage. So as I mentioned, the risk is very large if the deal doesn't go through. But like most of deals go through all the way to the end. But one or two deals falling through, it's going to have a huge impact on your portfolio because the stock price is going to go down, in some cases more than 50% if the deal somehow falls through. So you want to only select a few securities that you think that the probability of the deal going through all the way to the end is almost 100%. So even those situations, life is full of uncertainty. So you just want to implement the strategy just like Warren Buffett, where he only invests his money where he understands the deals. So let me just quickly go through the checklist that I just discussed. The first one was whether deal was announced officially or rumored. And second, you want to check whether deal is strategic one or financial one. Third, you want to see whether or not the acquirer already built up the stake in the target company. Fourth one is whether or not the acquired company is smaller in size relative to acquiring company. Fifth one is whether or not the acquiring company and acquired company shareholders are expected to approve the deal and whether or not the deal is friendly or hostile. The sixth one is you check if the deal is expected to be done via cash or stock exchange. The seventh one is whether or not the funding is secured from acquiring side. And eighth one is you have to check regulatory concerns and issues such as antitrust concerns from the government. The last one is you check whether or not there are any unusual clauses in the contract. So those are the 9 things that I have on my checklist, and this is going to prevent you to engage in the deals that ultimately has very high probability of falling through. So you just want to watch out that item. So these 9 items in questions will determine the probability of the deal going through all the way to the end. And as I mentioned, you always have to strike a balance between this probability and the spread that you are getting from the deal. So if spread is not enough, and if you don't get, let's say, 40%, at least 40% annualized rate of return from the spread, after considering the timetable attached to the deal, then you may not want to take the risk of getting into the deal. I think in the past, the spread was quite generous in the market, but these days, because of a lot of competition, the spread has narrowed. But there are a lot of merger or acquisition announcements in the market, and if you look at some companies in small in market size, then you probably can find 1 or 2 great opportunities in this space. And instead of putting your cash in your savings account, this is probably alternative way for you to just stay away from the market and keep your money invested with high rate of return. I hope that you gained something out of this episode. And before I end this show, I wanted to repeat what I said at the beginning of this show about my investment website, which is called shareinvestmentideas.com, where you can exchange your investment ideas with others. I'll post my investment ideas and I'll just keep you in the loop in terms of these ideas. I'm probably gonna create some episodes with respect to some individual securities that I'm interested in and the ones that I already posted on this website. I hope you enjoyed this show and see you next time.